For millions of retirees across this country, 2026 could quietly change how much money actually shows up in their monthly Social Security check, and the word quietly is intentional. Because these changes aren't dramatic. They aren't shocking. They aren't the kind of thing you'll see in a breaking news alert. But for someone living on a fixed income, someone who plans their month around that deposit, even modest shifts can matter quite a bit. Some seniors will see slightly larger payments in 2026. That part is true. And it's genuinely good news, but here's what the headlines often leave out. Other costs are rising at the same time. Healthcare deductions, prescription expenses, grocery prices. And for some retirees, those increases could quietly absorb a good portion of any benefit adjustment. So today on Great Policy, we're going to walk through every major Social Security change for 2026 that retirees age 65 and older need to understand. We'll cover the cost of living adjustment. We'll explain what's happening with Medicare costs. We'll talk about full retirement age, the taxable wage cap, earnings limits for working retirees, and even how your Social Security benefit can sometimes affect your tax bill. We'll also spend time on something that doesn't always get enough attention, the real human concerns that retirees across the country are carrying right now. Because this isn't just about numbers, it's about financial peace of mind. And that's something every person watching this video deserves. Quick disclaimer. This video is for informational purposes only and is based on publicly available information from government agencies and reputable financial reporting sources. It is not financial, tax, or legal advice. Always consult a qualified professional for guidance specific to your personal situation. Let's start with the change most retirees are already talking about. Every year, Social Security benefits are adjusted to help retirees keep up with rising prices. This is called the Cost of Living Adjustment, or COLA, and for 2026, that adjustment is officially in effect. Now, before we get into what this means for your check, let's take a moment to understand how COLA actually works. Because there's a common misconception worth clearing up. The Social Security Administration doesn't just decide on a number and announce it arbitrarily. The COLA is calculated using something called the Consumer Price Index for urban wage earners and clerical workers, which most people know as the CPIW. The government tracks how much prices have risen across a range of goods and services, and then Social Security benefits are adjusted accordingly. The goal is straightforward. Make sure that the purchasing power of your benefit doesn't erode year after year. For 2026, the projected COLA reflects a period of moderating inflation, meaning prices have still been rising, just not at the same pace as they were a few years ago. The result is a modest, but meaningful increase for most Social Security recipients. Now, what does modest mean in practice? Let's use a simple, concrete example. If a retiree is currently receiving around $2,000 per month in Social Security benefits, even a small percentage adjustment, say 2.5%, would add roughly $50 per month. That's about $600 over the course of a full year. For someone managing a tight budget, that's not nothing. That could cover a utility bill, a prescription refill, a few weeks of groceries. For retirees receiving higher benefit amounts, the dollar increase is naturally larger. For those on lower benefits, it's smaller. But the percentage adjustment applies equally. And that brings us to something important that many viewers may already be feeling in their day-to-day lives. The COLA is designed to offset inflation. But the inflation that Social Security uses to calculate this adjustment, the CPIW, measures spending patterns of working-age Americans. And research has consistently shown that older Americans often spend a larger share of their income on healthcare and housing. Those categories have been rising faster than the overall inflation rate in recent years. So while the COLA will provide some relief, it may not fully match the cost increases that many seniors are actually experiencing. You may have felt this yourself recently. You walk into a grocery store, and something that cost $3 now costs $4. Your utility bill inches up. Your Medicare supplement premium edges higher. The adjustment helps, but it doesn't always close the gap entirely. That's the honest picture. And it leads us directly to the second change, one that, for many retirees, will quietly offset part of that COLA increase if you receive Social Security and you're enrolled in Medicare Part B. Your premium is typically deducted directly from your monthly benefit before it ever reaches your bank account. That's important to understand, because it means that when Medicare costs go up, the net increase you actually feel in your check can be smaller than the COLA headline suggests. And this is where many retirees get genuinely frustrated. Here's how it works. Let's say your Social Security benefit increases by $50 per month thanks to the 2026 COLA. But in that same period, your Medicare Part B premium increases by $15 or $20 per month. Your net gain, the actual additional money you receive, is now $30 instead of $50. For most recipients, this is the reality of the adjustment. The gross benefit goes up, but the net deposit after Medicare deductions may go up by less. Now, Medicare Part B premiums are determined annually by the Centers for Medicare and Medicaid Services, and they reflect the projected costs of the Medicare program, including physician services, outpatient care, and other covered expenses. Premiums have risen over time as healthcare costs have increased broadly. There's also something called IRMAA, the Income-Related Monthly Adjustment Amount. For retirees with higher income levels, Medicare Part B and Part D premiums may be higher than the standard rate. These income thresholds are adjusted periodically, and if your income from all sources, including required minimum distributions, investment income, or part-time work, crosses certain levels, you may be paying more for Medicare than the average recipient. This doesn't affect the majority of retirees. But if you're in that category, it's worth reviewing carefully beyond Medicare Part B. Many retirees are also navigating the costs of prescription drug coverage, Medicare supplemental insurance, sometimes called Medigap, and out-of-pocket expenses for doctor visits, specialist care, and procedures. All of these contribute to the overall healthcare cost burden that seniors carry each month. The point here isn't to alarm anyone. The point is to be clear about the full financial picture, because that's what actually helps people plan. A COLA increase is genuinely good. But it's most helpful when you understand exactly how much of it will reach your account, after all deductions. And for many retirees, the difference between the gross increase and the net increase is something worth knowing in advance. But healthcare costs aren't the only adjustment retirees need to understand in 2026. And this next one is especially important for anyone who hasn't yet reached their full retirement age. For Americans born in 1960 or later, full retirement age, the age at which you can claim Social Security benefits without any reduction, is now officially set at 67. This is not a new rule. It's been phased in for years. But 2026 marks the point at which the transition is fully complete. The gradual increase that began decades ago has reached its endpoint. And that has real, lasting implications for anyone approaching retirement right now. Let's break this down simply. If you were born in 1959, your full retirement age is 66 years and 10 months. If you were born in 1960 or later, it's 67. That 2-month difference may seem small, but the principle behind it matters enormously for long-term planning. Here's the key decision that millions of Americans face: when to start claiming. You can begin collecting Social Security as early as age 62. But if you claim before your full retirement age, your monthly benefit is permanently reduced. The reduction isn't a temporary penalty. It stays in place for the rest of your life. Claim at 62 instead of 67, and your monthly check could be roughly 30% lower for the duration of your retirement. On the other end of the spectrum, if you delay claiming beyond your full retirement age, up to age 70, your benefit grows by approximately 8% for each year you wait. That's a meaningful increase for anyone in good health who can afford to wait. So the decision isn't just about when you retire. It's about what you'll receive every single month for potentially 20 or 30 years now. Here's where the human reality enters the conversation. Not everyone has the luxury of waiting until 67 or beyond. Some retirees face health challenges that make waiting impractical. Others lose their jobs in their early 60s and need income to cover basic expenses. Some are caregivers for a spouse or a family member. Some simply don't have other savings to draw on while they wait. The decision of when to claim is deeply personal, and the right answer genuinely varies from one person to the next. What matters most is making that decision with full information, understanding the trade-offs, running the numbers for your specific benefit amount, and ideally consulting with a financial professional or using Social Security's own online tools to model your options. What many retirees don't realize is how significantly the timing of that first claim can shape their financial life for decades. It's one of the most consequential decisions of later life, and yet it often gets made quickly, under financial pressure, without a full understanding of the long-term impact. We'll talk about some practical steps later in the video. But first, let's look at a change that affects a different group of people, those who are still earning wages. Every year, there is a maximum amount of wages that are subject to Social Security payroll taxes. This ceiling is known as the taxable wage base, or the contribution and benefit base, and it typically increases from one year to the next, reflecting growth in wages and inflation across the economy. For 2026, this cap has increased again. Now it's important to be clear about who this affects. If you are fully retired and no longer receiving wages from an employer, this change does not directly affect your Social Security check. Your benefit amount is based on your historical earnings record, not on what you're paying into the system right now. This change primarily affects workers who are still employed and earning above the annual threshold. For those individuals, a slightly larger portion of their annual wages will be subject to the Social Security payroll tax in 2026. To put it simply, if someone is earning well above the previous cap, they'll see a small additional payroll tax deduction in their paychecks as the year progresses. Once their cumulative wages cross the new cap, those deductions stop for the remainder of the year. From a broader policy perspective, adjusting the wage cap annually is how Social Security keeps the funding mechanism aligned with economic reality. As wages grow across the population, the taxable base grows with them. It's one of those changes that most people never notice, unless they're tracking their pay stubs carefully. But it reflects the ongoing relationship between working Americans and the long-term stability of the Social Security program. And speaking of working Americans, there's an important subset of that group that deserves its own dedicated conversation. People who are already collecting Social Security benefits and still working at the same time. More Americans are working later in life than ever before. Some are doing it by choice. They enjoy their work. They want to stay engaged. They find purpose in staying active professionally. But many are doing it out of necessity. Inflation has stretched budgets, housing costs have climbed. And for millions of retirees, a part-time job or consulting arrangement has become a financial lifeline. If you're in that group, collecting Social Security before your full retirement, age and still earning wages, there's a rule you need to understand clearly. It's called the earnings limit. And it works like this. If you claim Social Security before reaching your full retirement age, and your earned income from work exceeds a certain annual threshold, Social Security will temporarily withhold a portion of your benefits. For 2026, that threshold adjusts slightly upward in line with wage growth. Here's the specific mechanism. For every $2 you earn above the annual limit, Social Security withholds $1 of benefits. So if your wages exceed the threshold by, say, $4,000, approximately $2,000 in benefits would be withheld that year. Now, here's the part that surprises many retirees. Those withheld benefits aren't lost permanently. Once you reach full retirement age, Social Security recalculates your benefit amount to give you credit for the months when benefits were withheld. Your monthly check going forward will be slightly higher as a result. The system, in effect, is just delaying those payments, not eliminating them. In the year you reach full retirement age, a different and more generous earnings limit applies. And once you've fully reached that age, the earnings limit disappears entirely. You can earn as much as you'd like from work without any impact on your Social Security benefit. This is a nuance that often gets lost in casual conversation about Social Security. People hear that their benefits might be reduced if they work, and they assume the money is gone. In most cases, it's not, but the timing matters. The cash flow impact in the short term can still be significant. If you're relying on your monthly Social Security deposit to cover rent or essential expenses, having a portion withheld for several months can create real strain, even if it's technically returned to you later. This is exactly the kind of detail worth understanding before you make decisions about returning to work, taking on consulting income, or picking up a part-time position during retirement. And it connects to one more area that surprises retirees more than almost anything else in the Social Security system. Many Americans assume that Social Security benefits are tax-free. For some retirees, that's true. But for others, depending on their total income from all sources, a portion of their Social Security benefit can become subject to federal income tax. And the details here are genuinely surprising to a lot of people. Here's how it works. The IRS uses something called combined income to determine whether your benefits are taxable. Combined income is calculated by taking your adjusted gross income, adding any non-taxable interest, and adding half of your Social Security benefits. If that total exceeds certain thresholds, up to 50% of your Social Security benefit may be taxable. If it exceeds a higher threshold, up to 85% may be subject to tax. Now, to be absolutely clear, this does not mean you pay 50 or 85% in taxes. It means that 50 or 85% of your benefit is included as taxable income, and then your normal marginal tax rate applies to that portion. But the thresholds that trigger this taxation have not been indexed for inflation. They were set decades ago and have remained largely unchanged. As a result, more and more retirees find themselves crossing those income levels, not because they become wealthy, but simply because other income sources like pensions, required minimum distributions from IRAs, investment dividends, or even part-time work have pushed their combined income slightly above the old limits. Some retirees are genuinely startled when they receive a larger Social Security benefit, perhaps due to a COLA increase, and then discover that the increase has nudged their combined income over a threshold, resulting in a higher tax bill. You may have experienced this yourself, or you may have a friend or neighbor who talked about this recently. It's more common than most people realize. The important guidance here is straightforward. Don't wait until tax season to think about this. If you have multiple income sources in retirement, even modest ones, it's worth reviewing your expected combined income each year. The Social Security Administration's website and the IRS both provide clear information on how this calculation works. And for anyone with a more complex financial picture, speaking with a qualified tax professional before the end of the year can help you plan ahead and avoid surprises. This is one of those areas where a little proactive attention can make a meaningful difference. And it brings us to a broader question, one, that goes beyond the technical rules and speaks to what retirees are actually feeling right now. When you talk to retirees across the country, and when you read through the conversations happening in senior communities, in letters to financial advisors, in comment sections on trusted financial channels, certain concerns come up again and again. They aren't always about Social Security rules specifically. They're about something more fundamental. They're about whether the money will be enough. Inflation has eased somewhat from its peak a few years ago, but it hasn't disappeared. Groceries cost more than they did 3 years ago. Utility bills have climbed. Prescription drug costs remain a persistent concern for millions of seniors on fixed incomes. Housing, whether you own or rent, has become one of the most pressured budget categories for older Americans. And then there's the longer-term question. The one that lives in the back of many retirees' minds: will Social Security still be there in the same form? With the same purchasing power? It's a fair question, and it deserves a calm, honest answer. Social Security is a program with dedicated funding through the payroll tax. It is not a program that operates on discretionary government spending in the traditional sense. There are ongoing policy discussions in Washington about long-term solvency and how to address the projected gap between incoming payroll taxes and promised future benefits. Those discussions are real, and they deserve to be taken seriously. But major changes to Social Security, if they come, typically phase in gradually and protect current recipients and those near retirement age. Historically, adjustments to the program have been designed to preserve its core function, providing foundational income to retirees, disabled workers, and surviving family members. The concern is legitimate. The uncertainty is real. But the picture is not one of imminent collapse or sudden crisis. Social Security, as a program, has been navigated through challenges before, and the political will to protect it for current retirees has remained broadly consistent across administrations. What that means for you, practically, is this. Plan based on what you know. Use your Social Security statement. Understand what your benefit will look like under different claiming scenarios. And if other income sources or savings can supplement your monthly check, even modestly, that flexibility provides a meaningful cushion. You can check your personal Social Security statement anytime through the Social Security Administration's online portal. It shows your estimated benefit at different claiming ages, your full earnings history, and other important details. It's one of the most useful financial documents available to you, and many retirees have never looked at it closely. There's real peace of mind in knowing your numbers. Not because the numbers solve every concern, but because uncertainty is harder to manage than clarity. We've covered a lot of ground today. And rather than leave you with an overwhelming list, let's close with a few focused, practical steps, things you can actually do in the coming days and weeks to feel more prepared and more confident heading into 2026. The first step is to review your Social Security statement. You can access it by creating a free account at ssa.gov. This statement shows your projected monthly benefit at different ages, your full earnings history used in the calculation, and any adjustments that may affect your payment. Even if you've already started collecting benefits, logging in occasionally helps you stay informed. The second step is to look carefully at your Medicare deductions. If you're enrolled in Medicare Part B, review how much is being deducted from your monthly benefit. If your deductions have increased, understand why. If you're close to any income thresholds that might affect IRMAA surcharges, it may be worth speaking with a financial or tax professional about how to manage your income sources efficiently. Third, and this is underrated, create or revisit a monthly budget that reflects current realities, not the budget from 2 years ago. The current one, with today's grocery prices, today's utility costs, today's insurance premiums. Understanding exactly where your money goes each month makes it far easier to spot adjustments you can make and resources you can seek out. Fourth, be aware of scams. This is genuinely important. Social Security scams have become increasingly sophisticated. The Social Security Administration almost never calls you unexpectedly. They will not demand payment over the phone. They will not ask for your banking information via text message or email. If you receive an unsolicited contact claiming to be from the SSA, do not provide any personal information and hang up or delete the message. Report suspicious contacts to the SSA's Office of the Inspector General. And finally, stay informed from trustworthy sources. Official government websites, reputable financial news organizations, and channels like this one that prioritize accuracy over clicks. Misinformation about Social Security and Medicare is widespread online. Taking a few extra seconds to verify a claim before acting on it can protect both your finances and your peace of mind. 2026 doesn't bring dramatic overnight changes to Social Security, but it does bring several adjustments that, together, can meaningfully affect how much retirees actually keep each month. The call-out provides some relief. Medicare costs will absorb part of it. The full retirement age transition is now complete. The taxable wage cap continues to rise. Working retirees face earnings limits that are worth understanding carefully. And taxes on benefits continue to catch many people off guard. None of this is cause for alarm, but all of it is worth understanding. Knowledge, in retirement, is more than just comfort. It's a practical tool. It's the difference between being caught off guard and being prepared. Between making decisions under pressure and making them calmly, with full information. That's what Gray Policy is here for. If you found today's breakdown useful, we genuinely appreciate you subscribing. Not for the numbers, but because it helps us reach more retirees who deserve clear, honest information about the policies and programs that affect their daily lives. And we'd love to hear from you in the comments. What expense has increased the most for you personally in the past year? Groceries, healthcare, utilities? Your answer might help shape what we cover next, because this channel exists to address the concerns that actually matter to the people watching. Stay informed, stay prepared, and take good care.